Welcome. Today is September 1st, 2025. We are living in the afterglow of the 2024 Bitcoin halving. This is a critical time. Historically, the year after a halving has been explosive for price. The supply of new Bitcoin was cut in half. Scarcity is now meeting a wave of institutional interest. The financial world is watching, central banks are whispering, retail investors like you and me are figuring out where we stand. This isn't just numbers on a screen, it's a fundamental shift in how we think about money. The conversation around Bitcoin has changed dramatically. It's no longer a niche topic for internet forums, it's a headline on major financial news networks. It's a line item on the balance sheets of publicly traded companies. Understanding this asset is no longer optional for anyone serious about building wealth. The questions are bigger now. Is it a true store of value like digital gold? Is it a risk-on asset that simply follows the stock market? Or is it something entirely new? Before we dive deep into the numbers and the news, I have something for you. If you subscribe to my channel right now, I will send you my exclusive Top 5 Crypto Terms Explained PDF guide. It's a simple, one-page document that demystifies the jargon you hear every day, from blockchain to DeFi. This will help you navigate the space with more confidence. Just click that subscribe button and the guide is yours. Now let's get into the core of it. Let's talk about the price. As of today, September 1st, 2025, Bitcoin is trading at approximately $135,000. This is a significant milestone. It represents a substantial increase from the lows we saw after the last bull market peak. The post-halving supply shock is a major driver. With fewer new Bitcoins entering circulation, the existing supply becomes more valuable, assuming demand remains constant or increases. And right now, demand is certainly not remaining constant. It is growing at an accelerated pace, which puts immense upward pressure on the price. This price point also shows a level of market maturity we haven't seen before. The volatility, while still present, has shown signs of dampening compared to previous cycles. Instead, the price action is being influenced by macroeconomic factors, just like traditional assets. Interest rate decisions from the Federal Reserve, inflation data, geopolitical stability. This indicates that Bitcoin is being integrated into the global financial system. To put this in perspective, let's use a simple analogy. Think of it like real estate in a prime location. At first, only a few pioneers bought land. Then, as more people recognized its value and a city grew around it, the price of that same land skyrocketed. Bitcoin is like a digital city. The early adopters secured their plots. Now, major corporations and investment funds are moving in, wanting to build their headquarters there. They are buying up the limited digital land, and that increased demand for a finite resource is what is driving the value up. The current price reflects the desirability of owning a piece of this digital real estate. However, it is crucial to remember that this is just a snapshot in time. The price of Bitcoin is a moving target. This is the foundation for our next discussion, where the experts think we are headed from here. When we look at predictions, we see a wide spectrum of opinions. This is healthy. It shows a robust market with both bulls and bears. On the bullish side, many prominent analysts are pointing to this cycle's peak occurring sometime in late 2025 or early 2026. Projections from figures like Cathie Wood of ARK Invest and major investment banks have put forward targets ranging from $200,000 to even $350,000 per Bitcoin. Their thesis is based on historical cycle patterns, where the most parabolic price moves happen 12 to 18 months after a halving event. They argue that the influx of institutional money through ETFs has created a demand floor that never existed in previous cycles. The logic behind these bullish predictions is rooted in a concept called Metcalfe's law. This law states that the value of a network is proportional to the square of the number of its users. As more individuals, companies, and even countries adopt Bitcoin, its network grows. Each new participant adds exponential value, not just linear value. Think of it like the first telephone being useless, but the billionth telephone making the entire network incredibly valuable. The bulls believe we are still in the early stages of this network growth, and the price has a long way to go to catch up to its potential utility and user base. On the other side of the coin, we have the more conservative or even bearish predictions. Skeptics point to the persistent risk of regulatory crackdowns, which we will discuss next. They also highlight the potential for macroeconomic headwinds. If the global economy enters a severe recession, investors might flee from assets perceived as risky, including Bitcoin. These experts might see a shorter bull run, with a peak closer to 150,000 or 180,000, followed by a significant correction. They emphasize that while Bitcoin has matured, it has not yet fully decoupled from the broader financial markets and remains vulnerable to global economic shocks. So, who is right? The truth is nobody knows for sure. Predictions are educated guesses, not guarantees. The most prudent approach for an investor is to understand both sides of the argument. Acknowledge the powerful bullish case built on scarcity and adoption, but also respect the bearish risks associated with regulation and the global economy. Your strategy should not depend on one prediction being correct. Instead, it should be built on a long-term perspective and an understanding of the fundamental properties of the asset itself. This balanced view is the key to navigating the inevitable ups and downs of the market. For years, the world of Bitcoin operated in a gray area. Is it a currency, a commodity, a security? This uncertainty created risk for investors and businesses. However, 2025 is the year we are finally seeing clarity emerge. United States, Europe. The US has moved towards a framework that largely treats Bitcoin as a commodity. It puts Bitcoin under the Commodity Futures Trading Commission, the CFTC. This is a significant development. It provides a clearer set of rules for exchanges, custodians, investment funds. That clarity is exactly what large conservative institutions need to enter confidently. This move to classify Bitcoin as a commodity is incredibly important. Regulating it as a security brings heavy baggage and strict rules for stocks and bonds. Regulating it as a commodity is more straightforward and treats it like a raw asset, gold, oil. That clarity has been a green light for many financial advisors, pension funds. It legitimizes Bitcoin as an asset class and moves it away from its Wild West reputation into a structured, regulated environment that big money understands and trusts. However, not all regulation is positive. Some nations are taking a harder stance. Countries are implementing strict controls on crypto transactions, capital flight concerns, illicit financing concerns. There's a global debate about crypto taxation. How are capital gains treated? Do you pay tax when buying coffee with Bitcoin? Different countries are giving different answers. That creates a fragmented global regulatory landscape that's hard to navigate. Regulation is a double-edged sword. Clear, sensible rules can catalyze adoption. They reduce risk, and they build trust. The approval of Bitcoin ETFs is one direct result, but overly restrictive or punitive rules can stifle innovation and scare away investment. Investors must watch rules in their own country and in major economic hubs. These rules will affect the value and utility of your assets for years to come. The single biggest story for Bitcoin in this cycle is the flood of institutional capital. For a decade, Bitcoin was primarily a retail-driven phenomenon. It was individuals, not corporations, who fueled its growth. That has fundamentally changed. The approval of spot Bitcoin ETFs in 2024 was the key that unlocked the door for Wall Street. These ETFs allow massive institutions to gain exposure to Bitcoin, pension funds, endowments, insurance companies, without the complexity of holding the asset directly. They can now buy Bitcoin with the same ease as buying a share of Apple or Microsoft. This is a game changer. Imagine a massive pension fund that manages billions of dollars. They might decide to allocate just a tiny fraction, say 0.5% of their portfolio to Bitcoin. For a $10 billion fund, that's a $50 million purchase. Now, multiply that by hundreds of similar funds around the world. This creates a constant, steady stream of demand for Bitcoin, structural and long-term. This isn't speculative hot money that will flee at the first sign of trouble. It's strategic, long-term allocation from the largest and most conservative pools of capital on the planet. We are also seeing corporations add Bitcoin to their balance sheets, following the lead of pioneers like MicroStrategy. More publicly traded companies are now viewing Bitcoin as a treasury reserve asset. They see it as a superior alternative to holding cash. Cash loses value over time due to inflation. For a company, holding a portion of its treasury in Bitcoin is a hedge against currency debasement and a way to potentially generate significant returns. Every time a major company announces a Bitcoin purchase, it creates demand and sends a powerful signal of confidence to the rest of the market. This institutional embrace has a profound effect on Bitcoin's narrative. It is no longer just a tool for tech enthusiasts or a speculative gamble. It is being recognized as digital gold, a reliable store of value for the digital age. When a respected financial institution, a Fortune 500 company, validates Bitcoin, it reduces the perceived career risk for other financial managers to do the same. This creates a domino effect. The first institution to adopt was taking a huge risk. The 100th institution to adopt is simply following an established and prudent financial trend. This is the wave of adoption we are currently riding. Beyond corporations, we are now seeing entire countries make strategic moves into Bitcoin. The most famous early example was El Salvador, which made Bitcoin legal tender. While that was a bold experiment, the trend in 2025 is more nuanced. Nations with significant natural resources or sovereign wealth funds are beginning to accumulate Bitcoin as part of national reserves. They're treating it like gold, a neutral reserve asset not controlled by any single country. This is especially visible in energy-rich countries. Bitcoin mining is energy-intensive. Nations with abundant and cheap energy can convert that energy into a hard monetary asset, hydroelectric power, geothermal power. Instead of selling excess energy cheaply, they can mine Bitcoin. That lets them effectively export energy as a global digital commodity. It's a profound shift, turning natural resources into a censorship-resistant store of value. Call it digital alchemy for the 21st century. This creates a new layer of geopolitical dynamics. More countries adding Bitcoin strengthens the network as a global neutral asset. Some call this a geopolitical game theory scenario. If one country accumulates Bitcoin, neighbors and rivals may feel pressured to follow. But there are challenges. The International Monetary Fund, IMF, has raised concerns. Other global financial bodies worry too. There's a clear tension, sovereign nations seeking monetary independence versus established global institutions defending the current financial order. How that tension resolves will be one of the most fascinating stories ahead. The game is on them, and the players are now entire countries. So, let's recap what we've covered. Today, on September 1st, 2025, Bitcoin stands at a pivotal moment. The price, hovering around $135,000, reflects a post-halving supply squeeze and an unprecedented wave of demand. This demand is not just from retail investors anymore, it's from the largest financial institutions in the world, now able to access Bitcoin through regulated products like ETFs. Institutional embrace is changing the landscape, legitimizing Bitcoin as a mature investable asset class. Wall Street adopting the digital gold of our generation. The information can feel overwhelming, but focus on continuous learning. The world of finance is changing. Staying informed is your best tool. This brings me back to my offer from the beginning. If you found this breakdown valuable, please subscribe to the channel. As a thank you, you'll immediately receive my top 5 crypto terms explained PDF guide. So, what should you learn about next? Now that you understand Bitcoin, explore what's built on top. Decentralized finance or DeFi. What is it? How does it work? That will be the topic of my next video. Thank you for your time today. Keep learning, stay curious, and I will see you in the next one.